Hi, everyone. Thanks for joining us this Friday afternoon. I am Beth Helberg, the Director of Partner Marketing with NAIFA, and we're really excited about this webinar with Fairway. Harlan Accola will be presenting, and he is the National Reverse Mortgage Director with Fairway and has been in the industry for many, many years. I don't know if he even needs an introduction, but I'm going to go ahead and turn it over to you, Harlan.
Well, thank you, Beth. We really appreciate the opportunity. I think this is one of the most important, probably one of the most important presentations that you'll be to, not because of me. I'm not going to be doing very much talking, but because we are incredibly fortunate, and I'm privileged and honored to have Peter Neuwirth with us, who wrote the book Money Mountaineering. Over 40 years of experience in the industry, in the actuarial area. I'll work on that for a little bit. And really, Peter doesn't need any introduction, but if you want to talk to somebody that knows a tremendous amount about money, economics, personal investments, he's the guy to go to. And I'm incredibly fortunate that I get to rub shoulders with people like this, ask them questions, learn from them. Sometimes my relatives will ask me, how do you know so much about retirement stuff? Because I hang around a lot of people that are smarter than myself, and I can draw on their 30, 40, 50 years of experience. And that's what we have in Peter Neuwirth. And he's going to be talking about his book, Money Mountaineering, and the relationship of home equity and the overall retirement plan. He's not going to be, this is not a reverse mortgage seminar. It's about the whole picture with his book. If you want to get a copy of his book, you can order it on Amazon, or you can get it for free from one of our loan officers. And you just contact Reverse Events at fairwaymc.com. I'll type that into the chat box and let us know that you want a copy of his book. You should read it. If you're serious about advising your clients, looking into the future, this is a very different type of a financial book. You need to be looking at that and reading it and digesting the information from somebody that has an incredible amount of experience in the insurance industry, in retirement planning overall. Now, before I turn things over to Peter and talking about his book, Money Mountaineering, that just came out about a month ago, I want to talk about a documentary that has come out from Doug Orchard Films just within the last couple of weeks. I think it came out the end of October. We have got several thousand screening cards available to NAIFA members. It costs $29.95 to stream this video, The Baby Boomer Dilemma. If you contact us, just like Peter's book, we'll give it to you for free. We have given thousands of dollars to Doug Orchard Films so that we can supply you. This is an 85-minute documentary. If any of your clients have ever had any question about the value of annuities, the value of the insurance industry, you need to watch this film. You need to watch it because it'll even though I know a lot about annuities and have worked and have been very positive about them and own them myself, I learned a lot from this, and I know that you will too. I'm going to give you just a very short preview of this video. And again, it is online that you can go and get this for $29.95, but you don't need to do that because as of next week, we are going to be, any of our loan officers are going to be handing this out to you and make this available, and you'll be able to take it from there. So I'm going to just play the preview here, and it's only a couple of minutes right before we get into Peter's presentation on his book.
If you're counting on a pension being there when you retire, you should be aware that there are consultant corporations are busy hiring to figure out how to screw you out of your pension benefit. And that's what's happening across the world right now.
And it's scandalous, and it's creepy.
Everybody seems to like a pension. If you doubt that, try taking it away from them and you'll see how people react.
Those are a risky type of retirement plan to operate because you don't have a lot of certainty today about what your obligations will be in the future.
Well, most people refer to me as the father of 401k because I designed, got internal revenue approval of the first 401k savings plan.
I don't want to do what my father's family did. I don't want to do that.
I know lots of people who have a 401k and it works really well.
When the dot-com bubble burst, my 401k became a 201k.
I did not know that you could lose money in a 401k.
I'm ready to retire. We have all of our money, and then the crash happens.
The reality is that you chose the risk-based option where money was in the market.
You give the burden of planning retirement, place it upon the shoulders of the person who knows the least. I think it was a disaster.
There's got to be a better way to try to save for retirement than using something where half your money can disappear almost overnight and there's nothing you can do about it.
And what's been happening over the last few years is, yes, our accounts have been growing. It looks like we're getting wealthier, but the income that we can get from that sum of money is shrinking.
Retirement is so much different, and the advisors need to shift to become income experts and retirement income experts and risk managers.
You have to figure out, what are you going to get from Social Security and Medicare?
It's been estimated that Social Security will run out of money, not entirely, but it will run out of money such that benefits will have to be cut by 1/3 for everyone, current retirees, future retirees.
What is often underappreciated is that doing nothing and really politicizing the issue is a way of doing nothing will result in a massive cut to everybody's Social Security benefits.
Isn't that nice that we start out the presentation with something so positive? But the fortunate thing is people like Peter Neuwirth, folks at Fairway that have access to $9.2 trillion in seniors equity, and those of you in NAIFA that use annuities and sell annuities and make them available to clients. And as we work together, we can solve this baby boomer dilemma. We can do it together. We simply have to make sure that we are joining hands and going out there and putting the client's best interest at heart. So again, that video, that documentary is 85 minutes long. It's available if you contact Reverse Events at Fairway, and we'll put you in touch with a Fairway loan officer. If you're already working with a Fairway loan officer, then obviously just check with them and they'll take it from there. But without further ado, Peter Neuwirth has worked in the industry for a long time and has also studied reverse mortgages and all of the products. Peter, thank you for being here. Thank you for writing that book. It's fun, it's entertaining, but most of all, it will help people be incredibly profitable and save thousands of retirements for the people that read it.
Well, thank you very much, Harlan. And I'm going to try to get my, I guess, is that up? Can people see that screen?
It is up. We can see it well.
Good. Well, anyway, thank you so much, Harlan. And I'm thrilled to be here. And boy, that movie looks great, and has a few folks I recognize, and a lot of wisdom I can see already in there. And you know, you could probably see by my face that I actually date back to that time. Was there when I actually had to learn about the new Section K of 401 in 1981. But even before that, I was with a insurance company, and I actually started my career at Connecticut General Life Insurance Company back in 1979, and basically sort of fell into the actuarial world because I was a math major, and you know, anybody that could do a little math could get a job in the life insurance world. And but once I got there, I never left. I mean, I never left the actuarial world, because it's been a great career, and it's allowed me to inhabit the world of money and see how it's changed and evolved over the decades. But I do want to talk about that first couple of years working for Connecticut General Life Insurance, because I bought my first life insurance policy in 1979. I was 22 years old, and I bought it from a pretty intrepid and out of the box thinking life insurance salesman who was just a little bit older than me. He worked for Northwestern Mutual, and his idea was to sell whole life insurance policies to actuarial students at Connecticut General. And he had the right idea because, we looked at the numbers and the numbers worked. And, he also realized that actuaries are long-term thinkers. And we saw that, yeah, okay, we're not going to make money in the next few years on this thing, but over the long term, this is almost a no-brainer with the tax sheltered accumulation and the, at that point, very high dividend rates that were provided on those policies. So I bought my first life insurance policy in 1979. Since then, I've accumulated 4 additional ones. And, the first one had I think a death benefit of $20,000. And, the projections told me that I was going to have a lot of money when I turned 65. Well, I do. And I accumulated 4 other policies, which today are worth about $400,000 or $500,000 in cash value and over $1 million in face amount. And it has been one of the best investments I've made in my career because I have used it for so many things. And I'll get into that a little bit when I talk about life insurance as a tool that you ought to have, or many people ought to have in their backpacks as they, soldier into the financial wilderness and as I say, engage in some money mountaineering. I will say also that the other thing I did very early in my career, and this was in 1980, was I bought a condo. And again, because the numbers worked. And even though I think my first mortgage, I got it, 12% or something, and prime rate was in the double digits. But that made sense too, because it was a leveraged investment and inflation was running in double digits. And it seemed like a no-brainer. And I looked around, I couldn't understand why everybody else wasn't doing it. But in the end, like I said, it worked out really well. But with that as background, I just want to tell you a little bit about where I went in my career and why I'm now able to talk to you all about this book. So first, let me just say that everybody I know is concerned about their financial situation, and most people don't know where to begin. Well, when I, have had a long career in the actuarial world, and I left the insurance industry in 1980, became a consultant, and consulted on retirement for 40 years. With the major firms. I worked for Hewitt Associates and Towers Perrin and then Towers Watson, and found that I was, like I said at the outset, I was never bored and had a wonderful time as an actuary throughout that whole career. And towards the end of my career, I felt that maybe this perspective could help others. And so I started writing, and I wrote a book and that was published in 2015 called What's Your Future Worth?, where I tried to give people a sense of what the actuarial perspective is and how actuaries try to balance time, risk, and money in helping their clients, in my case, big corporations, make better decisions with respect to their pension plans. And I thought, well, this could be applicable for individuals as well. And so like I said, I would spend my early mornings as my career was winding down, writing about the actuarial perspective. And again, was fortunate enough to find a publisher who published my musings in 2015, and got a chance to talk to a lot of folks about how the actuarial perspective can help people make better life decisions. And that book was really about sort of basic decision making and how to use the concept of present value to evaluate the potential possibilities, how the future might manifest itself, and choose a path that, would have the greatest present value to, navigate your way through life. And I sold a few copies and talked to a lot of folks about the book. And what I found was that people were kind of interested, but what they really wanted to know is what could they do about their money? How could they make better decisions, better financial decisions? And so I decided after I retired in 2016 that I needed to write another book. And this time I just focused entirely on the world of money and entirely on how an individual can make their way in the world of money. And, I've watched for 40 years people make, decisions that seemed irrational. I've seen them regret their decisions. One of the things I watched early on, relatively early, is people taking lump sum distributions from their defined benefit plans. And it used to be that companies were allowed to use a very, very high interest rate to do that. And so these decisions that people were making were not in their best interest. I mean, sometimes they were because they really needed the money and they had good reasons, but a lot of times they weren't. But they just didn't really understand the lay of the land and their options and what the consequences of those decisions might have been. So, as I said, I retired at the end of 2016 and took a couple more years and wrote a new book. And this is the book that I've got out there, and I hope you all consider reading it because, as I say, I'm an actuary. I very much believe in some of these tried and true vehicles and products. I mean, the life insurance industry has helped companies. They've been in business for hundreds of years, and actuaries have helped those companies stay in business for hundreds of years. And they've been providing financial security and comfort and risk mitigation to millions and millions of people. So I believe in the insurance industry. I believe in the mortgage industry, reverse mortgage industry, and I believe in annuities as well. And but I really believe that people are capable of making their own good decisions in this world. And that's what I set out to do with this book. So what is money mountaineering? Well, the first thing you got to understand about this book is it's not a financial planning book. Okay. I don't give anybody advice on where to invest, what to do. I will, tell people what I do and why I do what I do, but everybody's different and everybody has to make their own decision. And that's kind of the context and the framework that I look at this in, because as I look at the world of money, I see it as a dangerous mountain wilderness. It's complicated. It's so complex that you can't understand it. Nobody understands it. The way, different markets interact with other markets, the derivatives, the interrelation between, who knew that the fact that people defaulted on their mortgages would crash the stock market. I mean, back in 2008, 2009, the interrelation and the interconnections of markets globally and domestically is just beyond anybody's ken. And I mean, even the Fed, the Fed knows how they can perturb the system and how they can, cause things to happen. But do they really know what's going to happen when they do things? Well, occasionally they see a horrible crisis like the 2008, 2009, and they inject a tremendous amount of liquidity and things get stabilized. Again, in the pandemic, they did the same thing, but it's just super complex. Worse than that, it's uncertain. So if you imagine yourself in a wilderness, in this, where you can get lost, you don't know your way around. You don't know what the weather's going to be like. You don't know when there's going to be a storm, a fire, a flood. You don't know what's around the next bend if you're trying to hike through to, get to a place where you can pitch your tent. So it's complex, it's uncertain, and it's noisy. It's full of people running around that are going to tell you what to do with your money, how to, where to go. Some of them know what they're talking about. Many of them don't. Some of them know what they're talking about in their particular area of expertise, but they don't know you and they don't know your entire situation. And they don't always have your best interests at heart. Or maybe they do, but their financial incentives and the way they're compensated is not aligned with yours. So, you have to be careful. You have to be careful about what's out there. And if that weren't enough, we're basically irrational creatures. Our ability to determine what's risky is, we hear a rustling in the leaves and we think maybe that's a tiger that's going to eat us. We were not evolved to determine, should I get a fixed or a variable rate mortgage? So we are wholly unprepared for this wilderness. So the question is, what do we do? What can one do to survive or even thrive in a wilderness like that? And so, well, one more thing. And this is where why I say this is not a financial planning book. It's not a book that's going to give you any answers, because I believe every individual is unique and everybody has their own completely different financial situation. And not only do they have their own financial situation, their assets, their liabilities, who they're taking care of, how sick they are, how well healthy they are, what their family history is. Do they expect to live to 95, or did everybody in their family die in their 70s of heart problems? Everybody's different. So everybody's financial world or the relationship to their financial world is different. But much more important than that, what we are as individuals differs emotionally. We want different things. We're afraid of different things. Our attitude toward how much of a chance, what kind of risks we're going to take to get what we need is different. And then, while a lot of people are attentive and a lot of financial planners are attentive to those kind of differences, the one thing that I think doesn't get enough focus is people's time preference, because everybody is a little different in how much they value something today versus something tomorrow. And not just tomorrow, but 2 years from now, or 10 years from now, or 30 years from now. So it's not even simple to say, oh, I'm a low discounter. I care more about the future than I do about the present, and therefore I'll put aside more things today to have more in the future. People are different in terms of the near term versus the midterm versus the long term. So there's not one strategy out there. There's 8 billion strategies that are, appropriate for a particular person. I had a very close colleague who was a really fine actuary, used to design pension plans. And he said, if you've seen one pension plan, you've seen one pension plan. And so that's my feeling about financial planning. If you've seen one financial plan, you've seen one financial plan, and everybody is different. And as I say, I'm not going to tell people what I think they should do. I'll tell you what I did and why. And I'll tell you, maybe if I get to know you well enough, I'll say, okay, if I was in your shoes, here's what I would do. But what I think you ought to do is to look hard at who you are, what your relationship is to the world of money, and if you're of a mind to consider what I think are some principles to keep in mind as you venture into that wilderness. So what I'm trying to do with this book is, like I say, give you all a sense of the terrain, a trail map, maybe a compass to tell you the direction, and maybe a pair of binoculars so that you can see a little bit further down the trail. I mean, you're not going to be able to see all the way around the bend because the future is really unpredictable. You can imagine the future, you can imagine where those trails might lead, but you don't know until you actually get there. I do want to make this book practical. So people, it's not enough just to know what you're facing and where the dangers lie. I also want to provide some insight as to what kind of tools you should have in your backpack as you make your way through. I'll foreshadow a little bit by saying I think life insurance products, particularly whole life insurance product, is like the Swiss Army knife. It does lots and lots of things pretty well, and it's something you ought to have in your backpack. I think we'll talk about the other tools, but just since I'm talking to a bunch of life insurance experts right now, and those who are familiar with those products, just to let you know, I think life insurance products are really terrific things to have around, as well as annuities. Those are products that also I think are worth keeping in your backpack. So, as I say, I have really enjoyed my career, and but not everybody loves the world of money. A lot of people are scared of it. A lot of people just would rather focus on other things. So I'm not trying to get everybody to love financial products and thinking about money as much as I do. But I will show you where I've been and tell you what I've discovered, and hopefully my experiences can be helpful as you help the people, your clients, make their way in the wilderness. So. Let me just go back here. The problem that I see it of financial planning or making your way in this wilderness does not have what we call in mathematics a closed form solution. It's not one that you can just figure it out and now you've got the answer. So, and particularly one of the bigger problems within the world of financial planning is the decumulation problem. People accumulate, say you need $2 million or some number when you retire, and that's going to be enough. And we've done a really good job of shepherding people through that with 401k consulting, and a lot of the investment advisors have helped people accumulate good chunks of money that theoretically are enough to live on. But the devil is in the details. How do you live on a chunk of money that you've accumulated? And that's the decumulation problem. And that is a problem that does not have a closed form solution. And this is, some of the work that Harlan's familiar with, that I've done with some of my collaborators in the world of utilizing reverse mortgages in conjunction with 401k balances to find a retirement income strategy or a drawdown strategy that can maximize your opportunity to live on your resources is an area of research I've been doing, and I'm continuing to do that research. But the decumulation problem is not one that has been fully solved. And I believe that in addition to this, some of the strategies that my collaborator Barry Sachs and I have come up with, there are other tools that need to be brought into the mix, including life insurance and annuities. And so with that as backdrop, I'm going to go through the 6 principles that I lay out in my book that I think people would be well advised to keep in mind and as they soldier through. So I'm sorry, I'm not sure why this is not working the way it's supposed to. But
you're just going backwards instead of forwards. So just hit the other button. There we go.
There we go. Okay. So I guess I got a more complicated mouse than I should have. But in any event, so here's principle number 1. And I alluded to it earlier. Everybody's different. Everybody's values, objectives, and financial situation is different. And again, you might have a bunch of family members that you're taking care of. You might have assets that you don't think about so much, like the future income. So it's assets and liabilities, and the assets are not just what you have, and the liabilities are not just what you owe, but what you might earn in the future. The earnings capacity that you have is an asset. Your education is an asset. Your liabilities include things that you might end up having to pay in the future. Unforeseen contingencies are going to drop up. So it's not just what you have, what you owe, it's what you will have, what you will owe, and all of that is subject to all kinds of uncertainty. But everybody's different. And so you need to consider, first of all, what your situation is. And then, and only then, can you kind of move into some of the next principles. Okay. Principle number 2. Principle number 2 is about debt, because so many of the advice books and so many of the financial planners out there focus on what you have and what you can do with what you have to make it bigger and accumulate more. But debt is just as important, because debt is the other side of your financial. It's not just the negative assets, but debt is something that can actually improve and supercharge your accumulation and achievement of financial wellness. So taking on leverage when you you can or should. I mean, the classic example is buying a house, and you put down, 10 or 20% and you borrow the rest. You have taken on a huge amount of debt, which will leverage the accumulation of that net equity. But debt can also make you fragile, and it can if you take on too much debt, you can open you up to turbulence, which can wreck your financial world. And so we need to be very attentive to the debt in our lives, the debt capacity, the kinds of debt we take on, and use it strategically when appropriate, and be attentive to the fragility that it can add to our financial situation.
Just to interrupt for a second, Peter, this is something that I think everyone really needs to be aware of, because there's so many people that just hate debt, and so they don't want to reverse mortgage. The proper use of a reverse mortgage is far more important as to whether or not you get that. And that's why Barry Sachs and Peter have done so much work on showing the proper usage of debt during lead up to retirement, and then during retirement, of where it can enhance and increase your net worth, not decrease your net worth. And so that principle number 2 is obviously a super important thing that we both need to understand in working together with the insurance and the mortgage side. Thank you for really illustrating that well in the book, Peter.
Well, and Harlan, I would actually, that was a great lead into what I wanted to say about the variety of debt, because you just brought up reverse mortgages, which is a different kind of debt than what most people are used to. I mean, credit card debt, you kind of know what it is, and it has a ridiculously high interest rate. And traditional mortgage debt is, you pay your, it's fixed, variable, and maybe it's interest only, or it's negative amortization. It used to be negative amortization. I guess they don't do those anymore. But reverse mortgages are a different kind of debt, because it's a kind of debt where the interest accumulates, and there are caps on what you ultimately owe. So, I hesitate to put judgments on different kinds of debt, but there's debts that's probably more bad than good, although they're useful, like credit card debt. And then there's debt that's more good than bad, like reverse mortgages, which is a kind of debt that I think is worth, most people taking on at some point in their retirement, simply because there's very little downside to having a reverse mortgage. There's some upfront costs, but we'll get into that in a little bit later. But in the meantime, I want to talk about principle 3, because this really is kind of core to where I guess the kind of things that you as as insurance professionals and experts run into all the time when you're talking to your clients. I believe that people should, as a general rule, if they keep this principle in mind, get advice and get help in the same way they get advice from a lawyer. I mean, why do you hire a lawyer? You hire a lawyer to see if you're to get out of trouble. You hire a lawyer to see if you're in trouble. You hire a lawyer to execute a transaction, maybe to evaluate a transaction. But every time you hire a lawyer, you're hiring somebody who's an expert in the particular thing that you need to address, and you're very sure that that lawyer is working for you. Now, as a practical matter, you can't quite do that in the financial world, because there are just so many business models and so many compensation arrangements that are not just pure fee for service like a lawyer is. But even lawyers aren't always compensated that way. But the key is to make sure that who's ever working for you, you're getting the help that you know you need. You're getting it from an expert, and you're getting it from somebody you can trust, and it's somebody who's on your side. Now, sometimes you can get there by making sure that the compensation of the advisor is aligned with yours, but Not always. Certainly not when a professional is getting compensated on the basis of the transaction, but that doesn't mean they can't be 100% on your side. But unfortunately, these days, we're getting advice and help from human beings and not yet robots. And so when you're getting advice from a human being, get to know that human being, get to know them and do your due diligence and make sure you can trust them. And so keeping principle number 3 in mind is very, very important. Okay, principle 4. Okay, here's the one that nobody likes to appreciate. Nobody likes to accept and believe that it's impossible to predict the future. But, time and time again, we're finding that the world changes by things that have never happened before. I mean, the financial crisis of 2008 and 2009, nobody knew that. Nobody saw that coming. Nobody saw really this pandemic coming in the way it hit. I mean, the unemployment rate went from below 4 to over 14 in 1 month. That has never happened before, and it never happened even during the Depression. So you just don't know what's going to happen. So we have to learn to live with uncertainty. We have to learn to be able to be flexible. We have to learn to face the future without fear and just be curious and open-minded about what's going to happen next. Now, just because the future is impossible to predict doesn't mean it's impossible to imagine. And that's where principle 4 comes into play. You want to imagine all of the possibilities, not just what you think is going to happen, but what might happen. Good things that might happen, the really good things that might happen, and the really bad things that might happen. And then you want to have a financial strategy that can adapt, or you're not surprised when one of those things happen and you're prepared for it. Which brings me to the 5th principle, which is to organize your financial life in a way to survive a severe economic or life event and strive to be anti-fragile. Now, what is anti-fragile? Anti-fragile is a word that you won't find in the dictionary, but probably a number of you, if you've read Nassim Taleb's Black Swan and his even better book, Anti-Fragile, you'll know what it means. That the opposite of fragile is not robust or strong, things that don't break when turbulence happens. The opposite of fragile is anti-fragile, things that will actually get stronger if there's stress or turbulence. Like, for example, your muscles. I mean, if you stress and strain your muscles, they'll get stronger. And consequently, you can do that with your financial life. And well, how do you do it? Well, it's basically comes down to what my father told me, which is, and this whole principle comes down to some advice he gave me, which is hope for the best, but prepare for the worst on the one hand. And on the other hand, keep many irons in the fire, because you never know which one is going to catch fire and help you keep you warm. So principle 5 is another one that I think people should keep in mind. Again, this is not a specific thing you should do. It's just a mindset and a principle to operate under as you try to make your way through the financial wilderness. Finally, the last one is, equally important to my mind, which is recognize that we are irrational. We are subject to emotional biases, to cognitive errors. We were not built to calculate probability and statistics, on the fly and figure out exactly the probability of one thing happening and making a really good bet on that. on that score. And so therefore, what you need to do is have some humility, have some self-awareness, understand where your limitations are, and get help when you need it. So when you recognize that you have these, and again, I don't call them flaws. I mean, a lot of cognitive, behavioral economics people like to talk about programming flaws in our wiring. I don't think of our brains as having programming flaws. I think of them as having features. And, yes, some of those features are that we value the present way more than the future. Some of them is that makes us very, very risk averse. Some of it makes us super risk tolerant. But whatever it is, be aware of your own wiring and your own way of doing it. And don't believe that there is some objective, perfect, rational mind that you need to aspire to. Just recognize who you are and where the flaws are, and go forward. So those are the principles. Now I'm going to move to, and I guess I got about 15 minutes left. So I'm going to move to, how do you put them into practice? And again, there's no general answer to that, but I do believe that as you make your way in the wilderness and you have these, you keep in mind these 6 principles, there are some tools you can keep in your backpack, because they will serve you well, and many of them will serve you over your entire adult life, into retirement and beyond retirement, to leaving a legacy behind. So what are they? Well, basically they come in four different categories. The first one is real estate, your home. And it's not just your home. I mean, Harlan's, has mentioned the reverse mortgages, but when we get to that slide, I'll show you there are perhaps 9 different ways you could use your home to enhance and achieve financial wellness. Second thing is permanent life insurance. I do believe that I believe in a lot of different life insurance products. I think VUL is a terrific product. I think UL is a terrific product, and guaranteed renewable term is a good product. I mean, there's a lot of very, very useful products. I mean, people say to me, and I get this question all the time, well, isn't it better to just buy term and invest the difference? Well, maybe if you need a scalpel to, cut some flesh, maybe, but I would rather have a Swiss Army knife where I could, cut what I need to, open a bottle of beer if I have one on the road, or pull out a corkscrew. I mean, it's a tool. Life insurance is a tool that has many, many uses. And then there are retirement income generators, and that's where the annuities come in, because there are ways to produce income streams for yourself. And I don't put reverse mortgages in that category. I think it's far, far broader. But life annuities, maybe rental real estate, maybe some limited partnerships. I mean, those are retirement income generators that you should think about. And then finally, when you think about leaving a legacy, and I do believe financial planning actually goes beyond our life and goes into what we leave behind for our heirs and our kids and others that we want to give away to. So those are the 4 tools. And why don't I first touch on real estate, because we spent a lot of time. I spoke to a group of reverse mortgage lenders, and we spent a lot of time on this slide. But And it's important because I think all of your clients, or many of your clients, will have real estate. And part of what you're providing protection for through life insurance is the ability of the family or the individual who's being insured to stay in their home, to continue to pay their mortgage, to maintain this very important asset. Real estate is the biggest, the net equity in their home is the biggest asset that most people have. And I mean, I don't have to tell you all that. I'm sure everybody who's in this business understands that. But home equity is about twice. There's about, I don't know, 10 trillion, I think. And I mean, Harlan probably knows the numbers better than I do.
Just short of 10 trillion, about 9.5 trillion. That's exactly right. More than there is in 401ks, and one of the most neglected assets there are.
Right. I mean, I think 401k was, last I looked, about 5 trillion, and maybe it's gone up since then, but it was about a 2-to-1 ratio between home equity and 401k. And yet financial planners were not taking that into account, in part because there was no good way to get liquidity from home equity. Now there is. And so here, what you see in front of you is 9 uses of a home. And I have used the first 7. I mean, I have every single one of those 7 I have used at one time or another, as I've taken the condo I bought when I was 23 and traded up to a house, my first house in Southern California. And I got lucky. I got a house in Southern California in the early 80s. And, and then I ended up with 2 houses. So now I've got a couple of houses and a couple of $1 million worth of real estate. And yeah, I mean, I got lucky, and it doesn't work that way for everybody. But throughout that whole 40 years, I have used that home for lots and lots of different things. And numbers 8 and 9, that's coming. I mean, I'm older than 62, and I guess I just haven't gotten around to getting a reverse mortgage, but I will. And
we're going to take care of that next month, Peter.
Okay.
So we'll cover that.
And when I'm gone, that home is going to go to, somebody I love and somebody I care about. So, but that's real estate. But life insurance, again, I believe that life insurance, just like reverse mortgages, and particularly whole life insurance, just like reverse mortgages, has gotten such a bad reputation for no good reason. Actually, I guess the reason is because it doesn't pay off immediately. It's a long-term proposition, and it's very, very complicated and hard to communicate. And that, frankly, is why it's not as, to my mind, as, quote, financially efficient as term insurance Invest the Difference, because term insurance is a very simple product. Whole life insurance is not, and it's a complicated. And having been on the other side, being an actuary working for a life insurance company, I know that these things are very complicated to build, to set up reserves, set up surplus for, to find ways to have them underwritten and then sold, because they do need to be sold in the sense that people won't buy them unless they understand them. And so hopefully the group I'm talking to understands them well enough to communicate. And again, I don't think, high commissions is a bad thing, because that's what it takes to get people who are expert in this field and have the ability to communicate a very complicated product to people who don't deal with this kind of thing every day. So,
and we're running, I know we're running short on time, but one of the things I'd like to mention is a lot of people that want to buy life insurance are too busy paying money to us trying to pay off their house. If people put less money into home equity, that $9.5 trillion in home equity, they could put more money into life insurance. And that's why it's so important that NAIFA and our team work together, because sometimes people recognize the value of it, but don't have the money because they're spending too much time paying off their house.
Well, yes, and they may even, they're also getting, a lot of people are getting, a lot of pressure from their employer and their 401k providers. Increase your deferrals, don't just get the match, which is almost a no-brainer, but put more in, because, and there's all kinds of illustrations that show how much you can accumulate. Maybe not. Maybe you want to take some of that discretionary savings and put some into a life insurance policy, which essentially operates like a Roth, only better than a Roth, because it accumulates tax-free. And when the money comes out, it comes out tax-free at death, and you can borrow at very tax effectively, and you can withdraw basis tax-free. So again, I don't want to spend too much more time here, and I want to leave time for questions, but these 6 uses of permanent life insurance are really important. And, I've used them all. I mean, again, for the home, I've used only 7 of the 9, but for these, I've used all 6. And I would encourage many others to do the same. So I'm going to just quickly touch on RIGs. And RIGs is a term that was coined by Steve Vernon, who's another collaborator and friend of mine. And he's got a great consulting firm called Rest of Life Consulting. And he talks about RIGs, and he's written a few good books too. And these are the things that you ought to think about having. And then finally, there's the plan gifts. When it comes to the end and it's time to leave a legacy, consider buying an annuity, but not necessarily, you can buy an annuity, it's going to be more expensive from a university, but on the other hand, you're going to be benefiting an organization that you care about. And with that, I'm just going to sort of end and let you know that well, I'll put up there, and you can reach me, and I respond to anybody that asks. So
well, thank you so much, Peter, and please feel free to type into the chat box or the Q&A questions that you have. But one of the main questions that I have, because we are the whole purpose of Fairway being aligned with NAIFA, is we believe there is such a strong connection between life insurance, annuities, and the reverse mortgages, because of the fact that they're maligned, as you said, but it's a matter of waiting. It's the difference between a microwave and a crock pot, I guess, that people want instant, and they look at their life insurance statement after a year and say, well, look at this. And then they get a reverse mortgage and they look at how much money they lose in closing costs. And well, I don't want to do that. But it's interesting that at least the investment industry and insurance and annuities understand that you put money into an insurance and you get it out. You put money into an annuity or a Social Security, whatever, and you get it out when you get older. Why have we done such a bad job in the mortgage industry that, even though you're very familiar with taking money out and you've done all of this research with Dr. Barry Sachs on using a reverse mortgage that you can pull money out that you put into your house, why do you think people are so averse to doing it? Less than 5% of people pull money out of their house when they get to be 62.
Well, I think it's a principle that I've seen that reputation outlasts reality. And unfortunately, and this was true of life insurance, it was true, and I think it was true of reverse mortgages at the very beginning when it was unregulated, when HUD hadn't come in and really cleaned it up, when professionals, knowledgeable professionals, hadn't said this is a good thing. There were some unethical people that took advantage of of consumers, and there were some really sad, awful stories. I mean, the same is true of viaticals and life settlements. I mean, the same is true of life insurance being sold to people that really didn't need it or wasn't appropriate for them. But it's a different world now. It's been cleaned up. It's better regulated, and unfortunately, so that's why I think you and the people you have at Fairway are doing a kind of a heroic job of educating the public on this and counteracting those bad stories, those stories that really are in the past. As the same is true of the life insurance industry. We have a history of that. Fortunately, the actuaries have added some order to the chaos, but it's still an uphill battle from an educational standpoint.
Well, and the thing that I really love about this book is sometimes it seems like, especially with the 6 principles, it seems like, well, that's obvious, but it's not. It really isn't. The amazing thing is the 6 principles are, a lot of people don't think they're irrational. They just think other people are irrational. And that is something, if you take a look at all 6 principles and you're a loan officer that sells reverse mortgages, or you're an insurance agent that sells annuities and cash value life insurance, all 6 of those principles bolster that we should keep doing what we're doing. We should keep selling life insurance. We should keep selling annuities and reverse mortgages, because it changes things for an uncertain future, which 401ks do not do. For example, if the market drops by 30%, you immediately feel the pain in that if you're in that situation. And in all of your decades of work, those 6 principles, those didn't evolve when you were just thinking over writing your book. You've seen that over the period of 40 years. And the curious thing that I have is, how much do you think irrational ideas and people not assessing and being open-minded, how much does that affect money management?
Well, I think it really comes down to principle 4. People are very, very uncomfortable with uncertainty, and so many people want and feel they have to know what's going to happen, and so they feel better when somebody tells them, yes, you do this, this will happen, and then it doesn't. And I think the answer is principle 4. Just be curious, be open-minded, be flexible, and things should work out.
Well, and that's so true. And I think that those of us that are professionals selling things, we also need to keep an open mind. It's amazing how many loan officers I've run into that don't like reverse mortgages. I was one 18 years ago that thought that. I've run into life insurance agents and financial advisors that don't like certain products, or don't like what we're selling, or whatever. And I think that open mind is such a huge issue, and that's the most valuable principle that I got out of your book. There was a lot of other things that I learned, but that was just that, hey, just a minute. I know for sure I don't know everything, and I've got a lot to learn yet. At 61, I'm still learning. So that's so true. Well, I know we're right up against the time. Beth and Julia, I really appreciate you hosting this for NAIFA. Peter, I can't be thankful enough for what you put out there. You only gave a little bit of a taste. If you want Peter's book, please get in touch with one of our loan officers, and we'll make sure that we do that. There's some valuable stuff here that your clients can benefit from, and you can benefit from. And remember that the reason Fairway is doing these series and the reason we have these webinars is, of course, we want to increase our business. But you know what the most important thing is? The most important thing is that we change the way retirement is done in this country. If you watch that video, it's scary. What happens? when all of a sudden we're looking at a decrease in Social Security of 30% when 50% of the people in the country depend upon it? What happens if inflation continues the way that it does? You know, we're stepping into a very, talk about money mountaineering. We're stepping into a desolate, scary landscape, and we don't know how many wild animals are out there to get us, and we have to work together. And by your industry and our industry working together, we can accomplish so much and use the wisdom of people like Peter Neuwirth to change the way that retirement is done, change the way people think, and make a difference for them. I'll leave the last words to you, Peter.
Well, again, thank you so much, Harlan. I really, you know, like I said, I wrote this book because I just feel like some of these ideas are I'd like to have them out there because I think they can help people. And I really am so grateful to you, Harlan, and Fairway and NAIFA for giving me the opportunity to share them with everybody. So thanks a lot. And I hope I get to see you again real soon.
Well, thank you very much, Peter, and Beth and Julia. Thanks so much for all you've done to make this possible. And we will make sure that we see you again. I think we've got one more yet this year, but if not, we'll be seeing you with some more series that we'll be doing in 2022. So thanks so much. And remember, get this book. You need to read it. If you're in the money business, which you all are, we all are, read it. It's way too much valuable. When you can talk to somebody that's got 40, 50 years of experience in the industry, that's what you get in the pages of this book. And and if you think this is just like any other book, I mean, a poker player wrote the foreword, Annie Duke. I mean, it's unique. It's different. You got to get it. And we don't expect you to buy it. We bought a whole bunch of them and we're going to make them available to you for free. We just very much appreciate getting this information out. Thank you very much. We'll see all of you folks. And if you need a recording, you will be able to get that, of course, from Beth and at NAIFA.
Yes. Thanks, Harlan, and thanks, Peter. And thank you, everybody, for joining us this afternoon. This will be available via recording in the next week. You'll get an email with information on how to access that. But thanks again to everyone. This was great information, and we look forward to the next one.
Thanks much.